Hey everyone, welcome back to the channel. My name is Connor Beck. 2022 has certainly been a wild year for the world of investors. For a lot of us, including myself, this is the first time experiencing a market crash outside of the brief COVID-related crash in 2020. And that crash recovered so fast, it doesn't even seem like it ever really happened. Because we have been in a bear market for most of this year, I've heard so many new investors question if they should be getting out of the market or pausing their investing until things start to get more certain in our financial and political landscape. And my reaction to this is always, whatever happened to buy low and sell high? And before we get any deeper into this, I have to throw out the disclaimer, of course, this is not individual investment advice. I'm just sharing some of my insight and research and my views around our current economic system and what I think of it moving forward. If you're looking to make any changes to your investing strategy, always consult yourself and any professionals you may work with regarding your financial well-being. That being said, let's jump into it. So where did we leave off? Oh yeah, buy low, sell high. It seems like everyone loves to recite that saying, but it seems like so many people forget it when we actually are in a time of turbulence. And I get it, trust me. Nothing sucks more than logging into your investment account to see that your portfolio has dropped by potentially thousands of dollars overnight. But we have to remember, these are normal occurrences in our current economy. If you don't believe me, stick around while I share a few facts that might make you feel better about continuing or even starting to invest right now. Okay, so I've been throwing around the term bear market. So let's first start by defining what a bear market actually is. According to seekingalpha.com, here's the definition. A bear market is one where the market declines 20% or more over at least a 2-month period of time. Bear markets indicate a downward trend in the market and can be triggered by a market correction where the market drops between 10% to 20% in a short period of time. Bear markets can be part of a recession where the economy has high unemployment and negative GDP output. So essentially, a bear market is just a significant downturn in the market that takes place over a relatively short period of time. Kind of seems like a big deal, right? Well, actually, not really. Let's start by jumping into the key points. Point number 1, there have actually been 28 bear markets since 1928, but really 29 if you count the one that we are in right now. That means that on average, we can expect a bear market roughly every 3.2 years. The US has experienced a crazy bull run pretty much since the financial crisis of 2008. So a lot of new investors, including you and me, don't really know what it's like to experience a bear market at all. It is essential for new and continuing investors to realize that downturns in the market happen, and they happen often. Investors who have been investing for long periods of time are aware of this, and they have a diversified portfolio that they feel comfortable with even when the market downturns. One of my favorite stock market analogies is one I heard from another YouTube account called The Money Guys. If you haven't checked him out before, I'd highly recommend it. But this is the analogy of the yo-yo. When most people think of the stock market, they picture it as a yo-yo, quickly moving up and down. Sure, you can make money when it goes up, but you're also going to lose money when it goes back down. But this view isn't entirely accurate. Really, the stock market is like a yo-yo that is carried by a hiker climbing a steep mountain. Sure, the yo-yo has its quick upturn and quick downturn, but over time, as the hiker continues to climb, the yo-yo also climbs higher and higher, even with its sporadic swings. This paints a great picture and shows us that even though the stock market will do whatever it wants on a short-term basis, over time, it's going to continue to climb that mountain and grow in value with that. So as I've mentioned, this fear in the short-term swings of the stock market are going to be the first hurdle that you must overcome if you want to be a patient and intelligent investor. And this brings us to point 2. Bear markets on average last for 289 days, while bull markets last for 991 days. All right, there's another term, so you might now be asking, what's the difference between a bear market and a bull market? Well, a bull market is just the opposite. Instead of a downward trend, it is an upward trend in the market. And isn't it so relieving that history has shown us that bull markets last much longer, which is often why investors get so spooked when a bear market occurs. They have been enjoying the upward ride for so long that they forget what to do when things come back down a little bit. So this brings me to a little exercise that we're going to do. What would have happened if you had pulled out your investments during the 2008 financial crash? Let's say that prior to the crash, at the very beginning of 2008, you had $500,000 invested in the stock market. When the market crashed big in October of 2008, your stocks dropped to about $350,000, and you decided that you couldn't handle the turbulence, so you sold off your entire portfolio and decided to keep the cash instead. Well, let's look at what you would have missed out on if you had done this in 2008. First of all, your portfolio would have recovered back to its $500,000 valuation just 4 years later if you decided to leave it in the stock market. And remember, that's a long recovery for a bear market. But 4 years isn't that long considering this is one of the largest financial crises our country has ever endured. But even worse than that, if you decided to stop investing in 2008, you would have missed out on one of the biggest bull runs in our nation's history. If you decided to keep your investments until today, your $500,000 portfolio at the beginning of 2008 would now be worth just over $1 million. Even with the bear market in 2008, and even with the one that we are experiencing today factored in. I hope this shows you that over time, it really makes sense to wait out the storm. When we get scared and we try to time the market, that is often the time when we make decisions that impact our portfolios the most. Now, before I move on from this exercise, I just want to take it one step further. Now, let's say in 2008, you not only left your investments alone, but you decided to invest another $2,000 each month. Your portfolio would be worth a little over $2 million today. This is exactly why I, at all times, am adding to my investments, especially when we are in a bear market. And this brings me right into point number 3. The market is on sale. I'm going to reiterate it again, guys. Buy low, sell high. Don't forget the saying, when the market actually drops and you are able to buy stocks at their low points. You should use this as motivation during a bear market to keep contributing to your investing. I know that every time I purchase more investments in market downturns, I almost get excited because I know that I should see a relatively quick return on those purchases. But let me be clear and offer you a warning. I'm not suggesting that you time the market this way either. My investing strategy always stays fairly consistent, whether we are in a market upturn or downturn. I'm not saying that you should wait to invest until we are in a downturn in the market, because honestly, we never know when that's going to happen. If you do, you may be waiting for years to get in, which means you'll likely be missing out on gains from a long-term bull run. So instead of using this advice to try to time the market, you should always buy into your investment strategy on a continuing basis, regardless of the current market outlook. But I'm suggesting when we do see a downturn in the market, you should use that little extra motivation to keep investing, because oftentimes that's when you're going to see the best returns on the money that you're putting in. Overall, I hope this video helped share some insight and helped cool your nerves a little bit when it comes to our current economic situation. In my opinion, this downturn in the market should surprise no one. We are finally feeling the economic effects of having the worldwide economy shut down or altered for the greater part of the last few years. So to me, this seems like a very normal cycle in our recovery to a normal economic outlook. But again, guys, that's just my opinion. Feel free to let me know how you feel down below in the comments. That's going to do it for the video today. If you enjoyed what you listened to today, please leave a like and a comment on this video. It would really help and I would really appreciate it. And if you are looking for more personal finance and business content here on YouTube, make sure to give me a subscribe. Thanks, everyone.